Good evening, all. Ira Epstein of Linn and Associates with your SPDR ETF wrap-up for this evening of Wednesday, and this is the 26th of August, 2020. So in looking at the market, we know it was another up day in the stock market, new record set. What's new? It's boring already, right? Well, it's not for those that are in the market on the right way. But what we looked at for now is the event of tomorrow and see if that has any impact. The event is the Kansas City Fed's annual Jackson Hole meeting. Now, normally they're in Jackson Hole, Wyoming, and they're able to get things going, and we get to see all the interviews with everyone. This time around, it's a virtual meeting, but if CNBC and Bloomberg and Fox are all doing it right, they'll be able to have virtual meetings away from that and talk to the different bankers, and we start getting a feeling for what's going on. I think the feeling you're going to walk away with is low interest rates for longer time. That's what I'm expecting to hear. Let inflation pick up. When it does, let it overshoot targets. They haven't made their targets yet. So overshooting's a big word for these central bankers if they use that. Maybe the targets are the wrong targets. None of us know. But that's going to be the theme of the day. We're going to hear tomorrow the GDP numbers. They're expected a contraction of 32.5%, a little less than was the first preliminary forecast. We'll see what that does. Energy markets, a little bit all over the board with different things, foreign currencies. The question is, if you look at the currencies in the euro and the dollar, you're seeing sideways action. These markets have reached a point where they're now consolidating for the next moves. So it is time to get excited about things again. I have been bored for the past week and a half. Now I'm getting excited again. Today I know in my SPDR ETF video in the afternoon, a lot of trade recommendations. So that's where they're at. Is this a breakaway gap? Remember, I've been pointing that gap out, and here's that second gap. Now, you might say, how did he know to start saying, look for this gap off that formation? Well, experience, that's number one. Number two, looking at volume, some of the other things that are going on. But now the question is, what do we have? If you had a third gap, let's assume tomorrow that just, instead of this, gaps again and goes. This could be called breakaway, runaway, and then exhaustion gap. Got to keep that at the back of your mind. It's rare that it happens this fast, but it could happen. So we'll see if this goes on. If you have questions about it, just put these different type in your Google. It'll explain what they are, but it's a bullish sign. It's not a bearish sign. It's a sign that people are now going, I'm missing this whole thing. I got to get in. That's typically what it means. And that's where you're at in these. You just keep running with the pattern higher lows, higher highs. You're over the 18-day average. I keep telling you how important this average is as a filter, and then it determines what the bias is. And when you're over it, the bias is up. And you'll notice each time we've broken it, if you've been a regular viewer, I've said, you know, this market has not been able to grab any traction to the downside and the breaks under it. I've been consistent in it, and fortunately, that's how it's worked out. I've also been consistent in saying you don't stay over Bollinger Bands for more than 5% of the time. It's a bet you have to win because statistics are on my side. That's what the algorithm will do. When you're over that band, it doesn't mean you're bearish. It means you're getting into borrowed territory. You're real frothy. That doesn't mean you can't jump more. That's not what it's saying. It's saying the odds are you're going to pull back under it. It's not that the trend is ending. But that is where pros understand the game, and a lot of algorithms and people that write their programs go, gee, I don't like being over that. I'm going to have tight stops, whatever. They realize it's likely to pull back in. This, to me, is the powerhouse, the slow stochastic oscillator, because what it's done is it's locked in. It's embedded. I could have called it locked in. I made up the name embedded to go with it. When it locks in, and you can see when this thing goes, the market goes with it. It leads price. So as long as it stays good, I'm in the bull camp. Buying this market has been very hard. It doesn't give you very many breaks to do it. SMH is not XLK. Let's understand it. It's not embedded. It's a whole different type of chart. It's a whole different product. It's the semiconductors, not the other charts that we have here, the tech sector per se. So people sometimes go, oh, I'm going to buy that. I'm backdooring it. Well, you're not. You're backdooring hardware. You're not backdooring the tech sector. And it's been a rough sector right there. Is the market trending? It is not. It's at a resistance point. It's got upside bias, and that it has maintained, but it's been a very difficult market. The XLI has been the one to be in. In the industrial sector, we had been in a correction phase up until just now. With this rally, we just took out a previous high. So now you've got in the chart a lower low and a higher high. So the market has just, I think, ended a correction phase. It is overbought, so the question is, what next? And that's what I'm waiting to see. In the energy sector, I'm still in the bear camp. I have not changed. The market's lower highs, lower lows, but it's an ugly pipe. And I showed in if you get my combo subscriptions where you see my futures videos in the morning and this one in the afternoon, you know that I've been saying this is just ugly. This is not the place to be. It's frustrating because you think you're going to break out to the upside, you don't. You think to the downside, you don't. If people were to ask me which way I think it's going to go, the fact that you're down in front of Hurricane Laura, it's not a good sign for the bulls. Wouldn't you think that you're going to do damage to the rigs, to the refineries and so on? Yet the market breaking down. What about in front of a central bank meeting where you know they're going to talk easy money? They're not going to say, I'm willing to bet with you that the market, let's bet a penny, one of you. Can't afford to lose more than a single penny. That the theme coming out of this is going to be, no, we're going to raise interest rates. Okay? I don't think that's the theme you're going to walk away with. I think the theme is we're going to have the markets back for as long as necessary, and that's what we're going to do. QQQ hits the upper band, gets above it, pulls back under it. I expect more of the same. Embedded reading, still very bullish. Emerging markets, whipsaw market. That's really what it is. I read like you do, and I know so many analysts are saying the emerging markets are the place to be, and I'm with them. I do understand it, and I think they're right. But the chart action just hasn't done it yet. I don't think they're wrong. I think they're fundamentally right, and I'm looking at that. I think that the U.S. stock market pulls everything with it, so the Chinese market takes off, the Japanese market, the Asian markets, and people start saying, well, which one hasn't met up with the U.S., and the money's moved back and forth. That's what I expect. In golds, we got up today high enough to 183.58 to take out a break, this high off the lower highs, lower lows. So we took that out. That, for me, negates the downtrend of the swing line. It hasn't put the market in a bull trend. It happened in an oversold condition. It's leading the futures. The futures haven't done this yet. I expect the futures will do it. You have to get over D's gold. I think it was 1970.10 was the number to get that done. This seems to me to be leading that. In the gold miners, you got up high enough to break the pattern too. So the pattern we had coming in today, lower highs, lower lows, oversold condition, well, I think the market has now neutralized all that and gone to just that, neutral pattern. TLT is still bearish to my surprise going into the Jackson Hole Symposium, oversold. We'll see if the 100-day average and the 18 offer resistance on rallies if they should come. FXE, sideways, just right here. I think the market, if it can get over 111.58, could flash its first buy signal for a challenge maybe back to the upper Bollinger Band. Right now, while the swing line is down, the momentum is up. You have to close back under that 18-day average to regain your bearishness, but if you take out 111.58, the pattern, unless you get back through today's low, would be higher lows, higher highs, and I'd have to see what momentum is doing. So I'm looking at that real hard. The other thing that I look at hard is teaching you. And if you're watching me talk about all this and any of it seems Greek, volumes 1 and 2 of our Guide to Technical Indicators will clear it up. It's not going to teach you how to use Bollinger Bands the way that I do. It's going to explain what Bollinger Bands are. It's not going to tell you how to use slow stochastics. It's going to explain what they are. My trading course will teach you exactly my technique with it. And the hardest thing for a trader is what I just went through for a week and a half, really not making trades. Now I'm starting to pull the plug again. In other words, I'm pulling the trigger is the right word. I hope it's not a plug, but we'll see what happens here. But I am now getting back in and putting out the recs for my clients and telling them it's time to move back into these markets, especially in the ETF and the spiders, more so than the futures. How do you get this information? Go to our website. How do you find out about my videos where I give you all those buy and sells? Go to our website. Under the keyword research at the top, you'll see a drop down. It explains my different programs that I have. All are very inexpensive by design. I'm Ira. You have a good day. Talk to you tomorrow.